If you look over the past decade, global equities, the broad stock market, delivered an average annual return of roughly 9%.
Which is incredibly strong.
Right. But meanwhile, if you look at standard UK cash deposit accounts, they limped along at about 0.9%. That is a staggering gap.
It really is. It's massive over time.
Exactly. I mean, when you compound that difference year after year, decade after decade, it is literally the difference between retiring comfortably and barely scraping by.
Yeah, that compounding effect is everything.
But here's the crazy part. Despite that massive premium just, sitting right there for the taking, only about 1 in 5 UK households actually hold stocks in their portfolio.
1 in 5. It's wild.
Right. So we really have to ask, why are so many people, perhaps even you listening right now, leaving so much potential wealth on the table?
It's one of the most enduring puzzles in personal finance, honestly.
Because the math is so obvious.
The math is incredibly clear. The potential gains are historically robust, and still the vast majority of the population just walks right past the opportunity. And, the reasons we usually give for this behavior might actually be entirely wrong.
And that is the core mission of today's deep dive. We are unpacking a genuinely eye-opening paper from January 2026 by James Simons Hicks at the London School of Economics.
Utilizing some really incredible data, too.
Yes, drawing on this incredibly detailed data from the FCA Financial Lives survey. So our goal today is to uncover the hidden barrier that's keeping you out of the market. And the solution we're going to explore is totally counterintuitive.
It really flips things on their head.
It does. It turns out the act of investing itself might be the only real cure to the very thing keeping you from starting.
Which, like you said, turns traditional advice completely upside down.
Right.
Normally, when we discuss low market participation, we assume the barriers are purely financial. We think people simply don't have the spare cash at the end of the month.
Or we assume the fees to get into the market are just, prohibitively high.
Exactly. But the data in this new paper reveals a completely different narrative. It points to a barrier that isn't about the monetary cost of entering the market, but rather the immense mental cost of financial literacy.
Okay, let's unpack this mental cost. But first, I think we have to put a stake through the heart of that old myth, right? The idea that you literally need to be rich to start investing.
Yeah, because historically, that was actually a very valid excuse.
Oh, for sure.
Decades ago, there were fixed entry fees, hyper-trade commissions, minimum account balances.
Like literally needed a broker on the phone.
Right. But that landscape has been entirely demolished by technology now.
Exactly. If you look at modern trading platforms, apps like Trading 212 or they have offered commission-free trading in the UK since 2018.
Yep.
You can just download an app, verify your identity, and buy a fractional share of a massive global company with a single pound. So the literal toll gates to the stock market are essentially gone. Anyone can walk in.
The gates are open, but the behavior of the public hasn't shifted to match that reality. And this is where that FCA survey data starts to get deeply fascinating.
Yeah, lay the numbers on us.
So, if you isolate households that have over £10,000 in liquid savings, so these are people who have built a solid financial buffer, right? They are absolutely not living paycheck to paycheck.
They've got breathing room?
Exactly. Among that group, 38% of them keep the entirety of those investable assets in pure cash.
Wow. Think about that for a second. Over a third of people with real savings are just letting it sit there, actively losing buying power to inflation every single year.
Just melting away.
Right. But I can already hear the objection from our listeners.
Yeah.
£10,000 is a great safety net, but it isn't quote-unquote wealthy. Maybe those people are just being cautious.
That's a fair point.
So let's look at the actually wealthy. The paper analyzes households with over £250,000 in investable assets.
Yeah, these are individuals with serious capital.
Serious money. And the researcher looked at how these wealthy individuals perform on a very basic 4-question financial literacy test. We were talking fundamental concepts here. Simple compound interest, the effects of inflation, basic risk diversification.
And the resulting correlation there is just staggering.
It really is.
Among these highly affluent households, if they score a 0 or a 1 out of 4 on that fundamental literacy test, they keep roughly 70% of their massive portfolio in pure cash.
70%.
70%. But if you look at the wealthy individuals who score a perfect 4 out of 4, that cash hoarding drops dramatically down to about 45%.
Okay, so the amount of cash they hold is inversely tethered to their understanding of basic financial mechanics.
Precisely.
I'm trying to picture how that actually plays out in someone's head because it requires a real shift in how we think about friction.
What do you mean?
Well, imagine you pay for a premium gym membership. You have access to the Olympic lifting platforms, the squat racks, the really complex cable machines.
Yeah.
But you walk in every day and you only ever use the treadmill.
Oh, I see where you're going.
Right. Why do you do that?
Right.
It isn't because the complex weight machines cost extra. The access is already paid for. You avoid the weights because they are intimidating.
Yeah, you don't want to look foolish.
Exactly. You don't know how to adjust the safety pins. You don't know the proper breathing technique. And the mental friction of figuring it all out while worrying you might get hurt is just too high. So you stick to the treadmill even though it's not giving you the optimal results.
That analogy captures the mechanism perfectly. What's fascinating here is that the researcher is proving that financial literacy isn't just some passive personality trait. It acts as a literal, non-monetary tax on participation.
A mental tax.
Exactly. For a household with low financial literacy, even if they have £250,000 sitting in the bank, the sheer mental bandwidth required to figure out the market is overwhelming.
I mean, think about the cognitive load. Choosing between an ETF and a mutual fund, deciphering a prospectus.
Understanding the capital gains tax implications.
Yes, it is exhausting.
It really is. So they are actually behaving quite rationally, in a way. They are staying out of the market to avoid this massive mental headache.
Even though they are essentially choosing to pay a massive opportunity, costs like sacrificing thousands of pounds and potential returns just to protect themselves from the cognitive overload of having to learn it all.
That is the exact trade-off they're making. They possess the wealth, but they lack the operational literacy to deploy it comfortably.
Which naturally brings us to a massive structural problem.
Right.
If a lack of financial literacy is the invisible barrier keeping people on the financial treadmill, how do we get them over to the weight machines?
Right.
Do we need to force everyone to read a stack of macroeconomic textbooks before they're allowed to open a brokerage account? Because historically, traditional financial education hasn't moved the needle much.
It hasn't, no. And the data in this paper explains why. First, we really have to establish the baseline here. There are huge, measurable gaps in financial literacy across different demographics.
How big are we talking?
Well, on that 4-point scale we mentioned earlier, men average a score of 3.29, while women average 2.80.
Okay.
And if you divide the data by education, degree holders score 3.34, while non-degree holders score 2.72.
So right out of the gate, we're dealing with a deeply uneven playing field.
Very uneven. But here's the mechanism that changes everything. As people invest more of their money into non-cash assets like stocks or bonds, those literacy gaps begin to shrink.
Really?
Yeah. By the time a household's portfolio reaches that £250,000 mark in non-cash investments, the literacy gaps across gender and education have virtually disappeared.
Wow.
The profiles of the investors essentially converge into a state of high literacy.
Okay, wait. Isn't this a chicken and egg problem?
Well,
I mean, if I look at someone with a massive stock portfolio and high financial literacy, how do we know the investing caused the learning? Couldn't it just be that smart, financially savvy people are the ones who decide to invest in the first place? It feels unsolvable.
it is a notoriously difficult loop to break for economists. You can't just look at a snapshot of wealthy people and determine which came first, the knowledge or the portfolio.
Right.
So to solve this, the researcher used a technique called an instrumental variable study.
Okay, in plain English, please.
In plain English, they needed to find a natural experiment. They needed to find a group of people who were suddenly thrust into the stock market through absolutely no deliberate choice of their own, and then measure if their literacy improved afterward.
How do you accidentally end up in the stock market?
Through unexpected inheritances.
Oh, okay.
Yeah. The researcher analyzed survey data for people who recently received a financial windfall. But, and this is a vital methodological detail, they specifically excluded anyone who received that inheritance from a deceased parent or a spouse.
Ah, I see. Because if your parents leave you money, they probably also shaped your financial habits over your entire life. The knowledge and the money would be hopelessly tangled together.
Precisely. If a parent teaches you how to budget and then leaves you a stock portfolio, We don't know if you're literate because of the stocks or because of the parenting.
Makes total sense.
So the researcher only looked at inheritances from greater social distances. Think of like a distant aunt or an estranged uncle.
Right, right.
This isolates the pure, unadulterated effect of suddenly receiving assets and being forced to manage them.
So what actually happens to a person when a distant relative suddenly drops a portfolio in their lap?
Their financial literacy scores fundamentally jump. Being unexpectedly pushed into the stock market raised their expected literacy scores by about 0.36 points on that 4-point scale.
Oh, wow.
It completely validates the concept of learning by doing.
I love that. Because when you suddenly own the asset, it becomes real. You download the app to check your balance. You start Googling what a dividend is because you just received one.
You start paying attention to the financial news.
Exactly. The act of holding the asset forces you to learn how the asset works.
Yes, the exposure mandates the education. And crucially, this learning by doing effect was far stronger for women and for individuals without a university degree.
Really?
Yes. The demographic groups that started with the lowest baseline literacy saw the highest rate of learning simply by participating in the market.
The friction is broken the moment you cross the starting line.
Exactly.
Okay, knowing that this learning by doing loop is a mathematically proven phenomenon, how do we apply it to the broader population? Because, not everyone has a wealthy distant aunt.
Sadly, no.
Right. And right now, we are looking at a looming retirement crisis across many developed nations where people simply do not have enough wealth compounded to support themselves.
This is where the paper shifts from diagnosing the problem to stress testing potential solutions. The researcher built what is known as a calibrated life cycle model.
Okay, what does that look like?
If you want to visualize it, think of it as a highly advanced simulation, almost like the video game The Sims, but designed by economists.
Okay, I can picture that.
In this virtual economy, they track thousands of simulated households. These digital people age from 20 to 80, they earn wages, they face unexpected expenses, and eventually they retire.
And within this simulation, they test out different policies.
Exactly. They tested different policy interventions to see what genuinely helps people build long-term wealth.
And specifically, they tested two different ways to give people a head start, right? They simulated giving one group a simple transfer of cash and another group a transfer of the exact same monetary value, but in the form of stocks.
The divergent outcomes of those two groups are stark. The cash transfer was essentially useless for building long-term financial habits.
Really? Useless.
Pretty much. When the simulated households received the cash, it temporarily relaxed their immediate budget constraints, and they simply consumed it.
They just spent it.
They spent it on goods and services. It had almost zero long-term effect on their stock market participation rate, and it didn't move the needle on their financial literacy over the course of their lives.
Because giving someone cash doesn't demand anything of them cognitively, but the stock transfer, that changes the daily mechanics of their life. You aren't just handing them value, you are mechanically dragging them across that barrier of mental friction.
Exactly. The stock transfer altered their entire financial trajectory.
Tell me the numbers.
Because the transfer was in equity, they had to hold it, which immediately triggered that learning by doing loop we discussed. As they monitored the stock, their literacy grew. In the simulation, the group that received the stock transfer, specifically a transfer of 0.25 units, ended up with a 30 percentage point higher market participation rate just before retirement compared to the baseline.
30 points higher.
Yes, and their financial literacy was 40% higher. And because they stayed invested over decades, capturing that 9% equity premium we talked about at the start, their actual consumption, meaning their standard of living and spending power during retirement, was 4 to 5% higher.
Here's where it gets really interesting for me. If we go back to our analogies, the distinction here is profound. Giving someone a cash transfer to solve their long-term financial struggle is like handing them a gift card to a nice restaurant.
I like this.
Right. They go out, they have a wonderful meal, and the next day, they're hungry again. But giving them a stock transfer is like physically dropping them into a professional cooking class. Not only do they get a meal out of it, but they're forced to learn how to feed themselves for the rest of their lives.
That encapsulates the policy implication perfectly. If governments or policymakers are serious about fixing the retirement deficit, leaning on cash handouts or basic tax rebates will not bridge the gap.
It's just a Band-Aid.
Right. The true friction isn't just a lack of starting capital, it is a lack of operational knowledge. In-kind equity transfers bridge that mental friction gap by forcing the education.
And timing plays a role too, right?
It does. The paper points out that the timing of this intervention matters. Doing this when a worker is 20 yields better compounding results than doing it when they're 40.
Because the money has more time to grow.
Yes, but not just because the money compounds longer, because the knowledge compounds. They have 20 extra years to let that learning by doing effect influence every other financial decision they make.
That makes total sense. I am trying to picture the macroeconomic reality of this, though. Let's say a government successfully implements this. We hand everyone a bit of equity when they turn 20, they learn by doing, and over a generation, we forge a nation of highly invested, financially literate citizens. Does this solve all our economic problems?
If we connect this to the bigger picture, it definitely does not create a frictionless utopia.
Okay, what's the catch?
When the researcher altered the simulation to model an entire economy where baseline financial literacy was raised by 25%, it revealed a really complex trade-off. It fundamentally changes how a nation reacts to adversity.
Walk me through that. Let's start with the benefits. How does this highly literate, heavily invested society respond to normal economic problems?
The primary benefit is that this highly invested economy acts as a massive shock absorber for real-world, localized crises.
Like what?
Let's say an individual loses their job, or there is a localized recession that hits wages, what economists call a negative income shock.
Got it.
In our highly invested simulation, because the population has much higher wealth tied up in compounding assets, their day-to-day consumption doesn't plummet. They have a deep financial buffer.
So they don't panic.
Exactly.
Yeah.
They don't have to instantly slash their grocery budget or default on a loan just because they missed a couple of paychecks.
They've essentially built their financial houses out of flexible timber rather than rigid stone.
Hmm.
The wind blows, they lose a job, the house sways a bit, but it doesn't shatter.
Beautifully put, yes.
But you mentioned a trade-off. Where does the vulnerability lie?
The vulnerability lies in the fact that by making everyone an active investor, you tether the daily well-being of the entire economy to the stock market.
Oh.
Yeah. The researchers simulated a sudden, severe stock market crash, a drop of 27.3%.
Ouch.
Exactly. In a low-literacy economy where most people hold cash, a market crash is mostly just noise on the evening news. But in our highly literate, highly invested economy, that crash causes a sharp, painful, and immediate drop in daily consumption.
Everyone feels it at once.
Millions of people simultaneously watch their portfolios hemorrhage value, they feel instantly poor, and they collectively slam the brakes on spending.
I can see how terrifying that would be for policymakers. If the stock market bleeds, the entire retail sector, the restaurants, the travel industry, everything feels the freeze immediately because everyone's wealth is exposed.
It creates a volatile feedback loop, yes. But the simulation revealed a vital silver lining regarding how that society recovers.
Okay, what's the silver lining?
Think back to your timber and stone analogy. The market crash is essentially a massive earthquake. The highly invested society takes severe structural damage immediately. However, because they are financially literate, they know how to rebuild.
Because they've been learning by doing.
Right. They understand market cycles, they know not to panic sell at the absolute bottom, and they know how to rebalance their portfolios as the market begins to turn.
So they bounce back faster.
Much faster. In the model, the highly literate economy rebuilds its wealth and returns to its normal standard of living in about 4 periods or years. A less literate economy, hit by the same magnitude of crisis, takes 14 years to recover its baseline.
Wow. 4 years versus 14.
Mm-hmm.
That is a fascinating psychological trade-off. They experience a sharper immediate pain, but because they possess the operational knowledge, they can navigate their way out of the rubble in a fraction of the time.
That is the ultimate macroeconomic compromise. Higher literacy and broad market participation smooths out the personal, localized bumps like job loss, but it inherently exposes the collective society to the broader roller coasters of global financial markets.
It genuinely makes you evaluate your own risk tolerance as a listener. Would you rather accept the constant slow drain of inflation and the extreme vulnerability of losing your job with no safety net? Or would you rather accept the volatility of the stock market, knowing that you've developed the actual skills to rebuild your wealth after a crash?
It's a huge question to ask yourself.
It really is. So drawing all of these threads together, the core insight of this deep dive is a profound shift in how we approach wealth building. The real barrier keeping you from compounding your money isn't the size of your paycheck, and it certainly isn't broker fees.
No, not at all.
It is the mental friction of simply getting started. It is the anxiety of staring at the weight machines and not knowing where to put the pin. But the ultimate trap is convincing yourself that you need to become an expert before you are allowed to touch the weights.
Which the data proves is completely backward. You don't need to study the market to start because the act of starting is the specific mechanism that forces you to understand the market.
So what does this all mean for you, navigating your own financial life? It means that sitting on the sidelines, hoarding cash, and waiting until you feel smart enough to invest is a behavioral trap.
A very expensive trap.
Extremely. And it is a trap that could easily cost you hundreds of thousands of pounds over your lifetime. The act of entering the market is the education itself. You have to buy the ticket to take the ride, and taking the ride is the only way you learn how the physics of the machine actually work.
I couldn't agree more.
And I want to leave you with a final thought to mull over something that pushes the boundaries of this research. We know that holding stocks is undeniably the best financial education available.
Absolutely.
And we know from the simulation that forcing someone to hold a stock transfer works infinitely better than a cash handout for building long-term habits. So, should we change the fundamental way we get paid?
Oh, that's an interesting thought.
Right. What if employers, or perhaps even the government, mandated that a tiny fraction, maybe just 1% of your very first paycheck at your very first job be paid directly in a broad stock index fund?
Wow.
Not as a retirement account you can't touch, but just as raw equity, just to mechanically force you to cross that mental starting line.
It would completely bypass the cognitive tax. A young worker wouldn't have to summon the mental bandwidth to choose to start. They would just have to figure out how to manage what they already own.
It is a wildly provocative idea for how we approach financial education in the future. But whether it happens through sweeping policy changes or just your own personal initiative tomorrow morning, the takeaway is clear. Don't let the mental friction keep you stuck on the treadmill.
Get off the treadmill.
Take that first step, buy that first fractional share, and let the learning by doing loop work its magic. Thanks for joining us on this deep dive.